All right, let me tell you about an HVAC business owner I worked with named Mike. 45 years old, owner operator, been in the trade a long time, runs multiple trucks, solid reputation, busy most of the year. And then one week, right in the middle of a peak season, one of his service trucks went down and had to be fixed immediately. See, Mike had the money to cover it, but some of it was earmarked for payroll. Some of it was waiting on invoices to clear, and then some of it was sitting in accounts he couldn't touch without paying penalties and a lot of taxes. So a few days later, he was talking to a friend of his who was also in HVAC. And Mike was talking about how annoying it was that every time something expensive popped up, it turned into a scramble. That's when the other guy said he used to deal with the exact same thing. And that's why he started keeping a portion of his money in a life insurance policy that he could access when stuff like this came up. And Mike was like, "What do you mean?" Because he had never thought of life insurance that way. To him, life insurance was something that you just had in case something happened to you. See, not something that you actually used while you were alive. So he started asking questions, and what he learned was simple. The money could sit inside a permanent policy designed to grow tax-free, stay protected, and still be accessible whenever he needed it. So he reached out to me and told me exactly what he wanted, and that's what we built for him. All right, so let me show you what this actually looks like. So what you're looking at here is the plan we set up for Mike. So we designed this as a 5-year funding plan. So Mike didn't want anything aggressive. He just chose to put in $25,000 each year, as you can see. So now that number made sense for him because it was money he was already setting aside during strong months without putting pressure on payroll or stressing the business. Now to him, that meant having cash he could reach when the truck went down or equipment needed to be replaced. Not having to reshuffle accounts or delay other obligations, and not leaning on credit cards or short-term debt just to keep things moving. And it also meant this: if work slowed down or something unexpected hit, everything wouldn't immediately tighten up at home or in the business. Now, longer term, it meant building something outside of the trucks and the day-to-day operations, and something that's still there, even if he decided to take a step back from the field later. So from age 45, he's funding this account at $25,000 per year. And over 5 years, that's a total of $125,000. Now, when you look at an illustration like this, there are a few things that you really need to pay attention to. First is going to be the cash value. Now, this is the money inside the policy that's actually earning interest. Now, when he puts money into it, there are going to be costs early on, and then the rest of that money flows into his cash value bucket where it grows over time. And the next column here is going to be the cash surrender value. Now, this is an important one. So this is how much money Mike can actually access from the account. So think of this as his available balance. This is the money that he can use if a truck breaks down, equipment needs to be replaced, the business hits a slow patch, or something expensive shows up out of nowhere. So there are no penalties, no age restrictions, no taxes when he accesses it. Now, that's a big deal for him because unlike retirement accounts, this money isn't locked up. So you also see a projected rate here. So in this case, it's 4.25. Here, it's something that's greater than 4.25. We just not stated on this illustration. So again, this is a projected rate. So this isn't a guarantee. And this is something that's based off of how the policy is designed and just historical performance over time. So we're not assuming anything crazy here with just 4.25%. It's just steady growth over time without any market risk. So when you zoom out and look at this after 5 years, here's the simple picture. Over the course of 5 years, Mike's only put in $125,000. And now he has a pool of money that it's growing, it's accessible, and isn't already tied up in the business. Now, instead of everything being trapped in checking accounts, equipment, or timing issues, he now has a place where the money can sit, grow, and be ready when the business needs it. Now, here's the part that really mattered to him. After age 50, he stopped putting money into this. Nothing else goes in. He just lets it do what it's designed to do. When we fast forward to age 65, you can see that there's still a good amount of money in the policy. Here you have 223,000, and here you have 348,000 at a greater return. And that's not just a number on a page, but actually flexibility. He liked knowing that if he wanted to slow down, step back from the field, or stop climbing in attics every day, he has something to actually lean on. Then we look at age 70, right here, and we have about $278,000 in cash, or here it's $486,000. Same story, and the money's still there. It's still growing, and he still has access to it. Now, for the first time, retirement didn't feel like an all or nothing decision. It wasn't about shutting the business down, it was about having options, and that's what this plan gave him. Now, if you're watching this and you want to see what something like this could look like for you, based on how your business actually works and how you make money, I'm happy to walk through it with you. You can schedule a call using the link below or just send me a message and we'll go from there. I'll talk to you soon.